Hey, and welcome to another video here at Fiscal Voyage. I'm Felix. And first off, I just want to make sure all you guys are safe out there in this pandemic. Make sure you wash your hands, very important. But with that, in this video, we're going to talk about Bank OZK. This bank is a bank that I personally own in my portfolio. And we're going to do a stock analysis of the company to determine if it's a buy, hold, or sell at current prices. So let's start.
Okay, here's the stock analysis on Bank OZK. It could be found in New York Stock Exchange as OZK. It was formerly known as Bank of Ozarks, which was found in Ozark, Arkansas. Right now, its headquarters is in Little Rock, Arkansas. The company has more than 250 locations in 10 states, which include Arkansas, Georgia, Florida, Texas, South Carolina, California, to name a few. And as of 2018, it had 22.39 billion in assets. Bank of OZK is currently concentrated in the southeastern U.S. with 25 or more branches in 4 states: Arkansas, Georgia, Florida, and North Carolina. So we're going to look at the fundamentals. From 2010 to 2019, the company grew revenue at an astounding rate at 19.8%, which is wow. Net income grew at an even faster rate of 23.4% from that same time period. Currently, S&P doesn't have a credit rating for the company, but the long-term debt to capital is only 7% as of fiscal 2019. So that's very low debt. Earnings grew in this time period from 2010 to 2019 at 15% compounded annually, which is great because that means if earnings are growing at double digit, that means dividends is growing at double digit. So let's continue with that. And the last 5 years, average earnings has dropped a little bit, but still at a nice pace at 12.1%. And revenue and net income from the past 5 years has been consistent with the 10-year average. So 2019, they had adjusted earnings per share of $3.30. Net margin came in at 43.3%, which has been consistent over the past 5 years, which is good margin. Return on equity is 10.8. That's been consistent as well for the past 5 years. And like I mentioned, the debt to cap is only 7%, which is great. They have very low debt, a good balance sheet. Currently, the company has a dividend yield of 5.87, which is outstanding considering most banks tend to have low dividends. But with the pandemic, which brought the price a lot lower, has bring the dividend yield up. And the company has a payout ratio of only 41.8%, which is great. The dividend is safe. And actually, the company just recently increased the dividends by 3.8% April 1st. So just very recently, they increased it. So that's great confidence from the management team that the company will go strong and go through this pandemic with no issues financially. They have 13 years of dividend growth, and the 5-year average is at 14.9%, which is kind of in line with the earnings growth. So that's so most part, when companies grow earnings at a particular rate, they tend to grow the dividends at that same rate or maybe a little lower. Net margin has been expanding versus last year at 42. So net margin grew a little bit for 2019 compared to 2018. And our charter rule has a rule of 20.8, which is the 5-year growth rate plus the current dividend yield. So that's outstanding. You like to see companies with a charter rule of 12 or higher, and now we got one of 20. And the 5-year dividend yield average is only 1.98%. And like I mentioned, you get a good yield at 5.87. So the current yield is much, much higher than the 5-year average. So that's a good indicator that the company is undervalued. So we look at the future outlook. 2020, analysts expect earnings of $2.60, which is lower than the 2019 of $3.30. So it is dropping because of the pandemic and I'm sure loans and things of that nature is going to be harder for people to get because of this pandemic, and a lot of people losing jobs, so they won't go get loans and things like that or defaults. 2021 is going to be flat for the most part with $2.58. CFRA doesn't have a projection, so I couldn't get a 3-year projection, but most analysts are expecting between 5 to 6% growth for the next 3 years. My dividend yield return model has a projected return of 14.1% annually going forward because of what I'm going to show you in the next couple slides. Forward PE of 7.2, and currently the company has a PE of 6 with a 5-year PE average of 15. So those are two indicators that the company is very undervalued at current prices. Here with fast graph, you can see the black lines are the monthly closing price, the orange is the PE earning price with a PE of 15, and the blue is the normal PE of 18.05. You can see here the black line is way under both the normal PE and the earnings PE multiple of 15, with the current blended PE of almost 6. So that's a good indicator that the stock is undervalued based on this fast graphs. And you can see here how the earnings is projected to be at $2.60 for 2020 and $2.58 for 2021, but picking up at 2022. But even if it stays flat, because of the fact that the price is so low, it has potential for great return. So let's get the fair price. CFRA doesn't have fair price value for OZK Bank, so we're going to use 4 fair value prices here. Morningstar at 24, Fast Graph at 38, Yahoo at 22, and my dividend discount model at $22.68. Averaging out to 4, we get a fair price of $27.37. Currently, the company as of today goes for $17.86, which means that the company is undervalued by a whopping 53.2%. So this blows my safety margin of 10%. So with that, I have a recommendation of buy. I currently own shares of this company, and I'm very happy shareholder currently. And I may increase my positioning by a few shares going forward. But right now, it's very undervalued, and I like it, and I'm a buyer right now. So that's why I have a buy recommendation. A lot of people, is a great bank, and a lot of people haven't heard of this bank. People know of Bank of America, Wells Fargo, Chase, and things like that. But Bank OZK is very a good bank financially, and it's making profit. It has a great dividend yield and the history. I love the fact that it has increased the dividend in April during this pandemic and closure and this whole market uncertainty. So that's a great confidence from management in the company. Some of the risks are that this is a bank, so there's possibly loan defaults and the fact that there's a lot of other bank competitors like it. So with that, if you have a company that you'd like to see next, please let me know the name of the company and ticker symbol and in the comments. And thank you for watching. And if you find this video informative, please hit the like button and subscribe to my channel for more videos like this. And you can see my portfolio in the link in the description below at my website, fiscalvoice.com. Stay safe, guys.